Hello, I'm Monica Gibson and you're watching the weekly wrap-up. As countries across the globe post their Q1 stats, Andrew Grantham joins us down the line to discuss what's been moving and shaking the markets. So Andrew, we've had horrid GDP from the US, a nonplussed Bank of Japan and of course the booming jobs data, providing the climax of the trading week. But even the full data feed perhaps pales into the background with today's news that tensions between Russia and Ukraine have worsened yet further. What would you say has had the biggest sway on market sentiment this week?
Yeah, well, I mean, it has, as you said, it's been very much an up and down week, especially with the US and the US dollar. The GDP figure on Wednesday came as a big shock, virtually no growth at all during the first quarter. But I think a lot of people, and us especially, are kind of writing a lot of that weakness off as a weather impact from the very cold and snowy weather that we had in the first quarter of the year. And while it was weaker than we expected, I think that just signals that we could get an even stronger bounce back in the economy in the second quarter. And we're already getting indications of that with the ADP survey, the ISM yesterday, and of course a very strong payrolls figure today. All of those indicate that we're going to see quite an upturn in the US economy in the second quarter, which should, I think, be a positive for the US dollar. As you mentioned, the tensions between Russia and Ukraine are starting to escalate again, and that is going to impact some safe haven currencies a little bit, maybe a little bit in the US, but I guess mainly the Swiss franc and maybe the yen as well.
Okay, so let's talk about that jobs report. 288,000 is a huge surprise and takes unemployment rate to the lowest since 2008. In a knee-jerk reaction, stocks soared to the news. However, there was zero wage growth, which still must be troubling for the labour market. Is the headline figure good enough to make Yellen and co change their mind regarding interest rates, or does 1 month not a trend maketh?
No, I mean, even without those, the weak trend in wages, then Yellen and company have shown when we had weak data earlier in the year, and now that we're getting some stronger data, that it's going to be the trend that changes their path, and that the path that they're on at the moment in terms of tapering QE and then potentially raising interest rates around the middle of next year, you're going to have to see quite significant and quite prolonged changes in the data flow to change them from that path. What we have seen, as you mentioned, the jobs report looked, at least at first glance, very positive in terms of payrolls, a lot higher than expected. There were a few notes of caution in there. Wage growth was very weak, but we have seen in the past, and our analysis shows that we don't actually tend to get much wage growth until we get to an unemployment rate below 6% and actually even closer to 5% in the US economy. So that's not wholly surprising to us, and it probably won't be wholly surprising to the Fed as well. One thing that they will be cautious about is another sharp fall in the participation rate, and that drove all of the downside surprise that we saw in unemployment today.
Elsewhere in Canada, an expansion of 0.2% was taken as good news, with analysts saying it suggests the Canadian economy is off to a pretty decent start for the year. One factor which might, however, cause a hiccup is the Vancouver port strike. We have some more Canadian data out next week. Is this having much impact on your outlook and for the CAD?
Yeah, so what we've seen in Canada is that the GDP figure this week came in line with expectations of 0.2%. The most interesting thing really about that GDP report was that there was a slight upwards revision to December. Remember, that was the month that we saw a really big impact from the ice storm. Originally reported down 0.5%, now down 0.4%. So we see from that actually the economy is rebounding from a slightly better base in the first quarter, and that does suggest that Q1 growth could come in around 2%, which is somewhat above what the Bank of Canada had penciled in their latest NPR projections. And Canadian data next week, it is possible that the Vancouver port strike could have some impact on the trade figures. We are still expecting a pretty decent positive trade balance out next week may have been even more positive if it wasn't for that strike. So, that I think that would still be positive for the Canadian dollar. And we are seeing kind of broadly positive Canadian data for next week. So we're also looking for slightly above consensus readings on housing starts and the employment rate and the employment change as well, which caps off next week. So the US dollar, I think, is going to be a strong performer as the US economy picks up, but I think the Canadian economy is also riding the coattails of that as well. So the Canadian dollar should do pretty well, especially on crosses against, say, the euro and sterling even.
Also rounding off the week was a European manufacturing, which surprised on the upside, causing some to believe pressure may be taken off the ECB ahead of next week's meeting and give them leeway to leave policy changes for another month. With this and everything we've discussed in mind, are you expecting dollar strength or weakness against the single currency moving forward?
Well, we're expecting dollar strength. We don't see the ECB kind of pulling the trigger on any kind of QE or any other alternative measures next week. We had, as you said, the manufacturing PMIs were a little bit better than expected, and also we saw inflation earlier in the week, kind of a mixed bag, slightly weaker on the headline, but there's a big surge in service sector inflation, which could grab the attention of some policymakers on the ECB. So while we're not expecting them to pull the trigger on stimulus, which would have a real big impact on the euro, we do still see that inflation and growth in the US is going to be improving or picking up to a greater extent than it is in Europe. So we're still expecting the US dollar to strengthen against the euro. We're expecting it to get down to Euro USD to get down to about 130 in kind of a 3 to 6 month time horizon.
Andrew, thank you. Well, will the markets take comfort in that jobs data, or will the hysteria be short-lived? Find out by watching our week ahead interview on Monday with Sophia Eribo. But in the meantime, have a lovely weekend. Goodbye for now.